Hello, everyone, and thank you for joining us for this new edition of UniTalks, which is entitled Working Poor and Mortgage Market in Luxembourg. My name is Chantal Englert. I'm a communications officer within the Faculty of Law, Economics, and Finance. I'm here today to moderate the webinar, and I am getting some help from Sasha Faratova, who is a communications officer from Central Communications. Before we begin, I just wanted to mention that in the last 4 UniTalks webinars, we've had over 500 participants, and this is really great tangible evidence that our community is interested in learning about the research that is being done at our university. So thank you for being here today, and thank you for attending the talks in the past and also in the future. Our last webinar of 2021 promises to be especially interesting and relevant to our daily lives. And for that, I am joined by 3 researchers from our faculty. So first up, we have Luca Ratti, who is from our Department of Law. He's associate professor specializing in European labor law. He's also coordinating the Working Yet Poor project, which is funded by our Horizon 2020 grant. This project brings together a consortium of 9 universities and 3 institutions. And what they're doing is looking into the working poor, who the working poor are in Europe, the issues they face, and providing policy recommendations to the decision makers and the legislature. Here, during this webinar, Luca will be speaking about his project with a focus on the situation in Luxembourg, where many workers, even those not considered working poor, struggle to find affordable housing. And this is where we're going to build a bridge to the finance-centered part of our presentation, starting off with François Coulicher, who is an assistant professor from our Department of Finance. And along with Professor Christos Koulovatianos, also from our Department of Finance, he has worked extensively on studying the fiscal, financial, macro, and microeconomic mechanisms that affect housing prices in Europe, and with a focus on Luxembourg in particular. Professor Koulovatianos has also coordinated the FNR COVID-19 Fast Track Project Mortgage, which studied the effects of the pandemic on Luxembourg borrowers' ability to repay mortgage loans. And he's also a member of the COVID Task Force number 7, which has specialized in financial stability issues. In this webinar, Professor Coulicher will be touching on his research into the evolution of housing affordability in Luxembourg, as well as how the market has reacted to the COVID shock, while Professor Koulovatianos will speak about the risks of this overheated market and what policy tools we have here in Europe and in Luxembourg to cool it down before it's too late. And with that, I hand it over to Professor Ratti, who's going to begin with his presentation. Thank you.
Thanks very much, Chantal. Thanks to all of you. I think we reached the overwhelming number of more than 100 participants, so it's very, very nice to see all of you here and a lot of familiar faces in the room. Now I will focus today on a topic which was kind of neglected, at least as far as law is concerned, until very recently, but which nowadays became much more popular for the simple reason that the phenomenon we look at, so that of inward poverty, is becoming more widespread in Europe. So first, some definitions of what is inward poverty, how do we measure it, and why should we be concerned about it? It's a very, very complex definition, that of inward poverty, because it takes into account an individual dimension. So it measures an individual who is considered at work, meaning that he or she spends more than 7 months per reference year working under a contract of employment, whose income, however, is calculated on the basis of a relative measurement. So it's calculated on the basis of the median household disposable income, but not only this is relative, it is also embedded into a collectivity, and the collectivity taken as reference point is the household. So, and there are kind of complex calculations behind this. So just in a nutshell, the statistical numbers of inward poverty not always reflect material poverty, so effective poverty, and we will see this in a minute. Why should we be concerned? Well, because increased inward poverty means also increased inequality in a given country, and increased inequality in a given country means a population, a working population, which is much less able to adequately respond to economic shocks, and in legal terms, which is no more fully capacitated to enjoy the rights and duties, but particularly the rights and entitlements deriving from their citizenship status. Now, we built up a consortium, and thanks to Chantal for remembering this, together with colleagues from the University of Luxembourg, particularly Conchita D'Ambrosio, Vincent Vagnat, and Antonio Garcia. And we are now, we are looking at 7 representative countries, the Benelux countries, Sweden, Italy, Poland, and Germany. And we are comparing the levels of income poverty, and we are asking ourselves, what is the place of the law there? We built our research on a new concept, that of VUP, which is vulnerable and underrepresented persons. You will see me using this concept quite frequently today. It is used to cluster the labor market and find out what are the parts of the labor market that are more affected by income poverty. And these are the 4 clusters. Cluster 1, VUP group 1, is low and unskilled workers who work in the so-called poor sectors. We selected a number of economic sectors like logistics, cleaning, and so on. And we found out that there is a strong correlation between the fact of working in those sectors and being already working poor, or at least at risk of poverty. Cluster number 2, self-employed person. This is a very, very diverse group of people with different levels across Europe. We will see later on that Luxembourg has a very, very low level of self-employed, while other countries kind of exploded in this. Third group, flexibly employed workers. This is temporary agency workers, CDD, so fixed-term workers, and particularly involuntary part-timers. Last but really not least, the category which became so sexy in the recent decade, casual, 0 hours, platform workers. The difficulty with this category is to really capture their numbers. If you yourself want to know whether you are a working poor or not, we have created a quiz. This is on our website. If you cannot click it now, I will put it in the chat after my presentation ends. What did the EU do so far to tackle income poverty? Well, there's a number of very interesting documents and actions which started tackling poverty as a whole, but then which I would say after the agenda Europe 2020, whose mantra was jobs, 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 the European Union started to be concerned about the quality of those jobs. And that's why, particularly in the last decade, we have seen European institutions more and more involved to put in place initiatives and tackle income poverty. Probably the most important of which is the European Pillar of Social Rights, which was declared in 2017. That's a political declaration and an interinstitutional document, which gave rise very recently to, I would say, 2 very important initiatives. One is a directive proposal on adequate minimum wages, which was presented in October 2020, and it's now under discussion between the European Parliament, the Council, and the European Commission. And the second one is the European Directive on the working conditions of platform workers, which was presented just a few days ago, and it now starts its discussion with the other 2 institutions. What about Luxembourg? Should we be concerned about income poverty? Because we have the feeling that we live in a very rich country where most of the people is living okay. So should we really be worried about the levels of income poverty? Well, some very basic messages. Income poverty in Luxembourg increased significantly in the last years. except I would say the very last years, which is measured by statistics, because we have seen a slight decrease. However, the levels of inward poverty in Luxembourg are very, very high compared to other European countries. It's the second worst performer with 12.1% now. It used to be 13% 2018, against an average of European Union 28/27 of 9%. Given this threshold, we also should take into account that we have very low levels of severe material deprivation, which means that there's kind of a gap between those that are at risk of poverty and those that are very, very poor, against an average of 5 point something percent at the European Union level. We have only 1.2% in Luxembourg. And what does it mean to be working poor in Luxembourg has a lot to do also with the wage which is derived from work, particularly with the levels of statutory minimum wage. You see in this table the latest data on statutory minimum wages. It seems that it's very high. It's 10 times, almost 10 times the minimum wage of countries like Bulgaria or Romania, but still a lot of people live in very close to the inward poverty line. Now, let me be very, very brief and quick about the 4 VUP groups. The only number I think it's relevant in this slide is the fact that compared to a 12.1% of all employed persons at risk of inward poverty, VUP Group 1 gathers 19.6%. So this simply confirms the fact that clustering the labor market makes a lot of sense, particularly in terms of legal response to these levels. VUP Group 2, this is self-employed persons. There's these are very few in Luxembourg, and I think we should take this into account. Nonetheless, the levels of inward poverty amongst the self-employed are anyway higher than the average level. VUP Group 3 is, I think, the group which is most concerned by inward poverty in Luxembourg, because temporary workers, meaning temporary agency workers and CDD, but also involuntary part-timers, suffer a greater level of inward poverty than the average employed person population. VUP Group 4, instead, I'm not saying that we have nothing to say with regards to platform workers and zero-hour contracts, but you may have seen that it's not that widespread in Luxembourg, and there's no legislation on this. So coming to a more concrete reactions by the country, what did Luxembourg do so far? What does it do to tackle inward poverty? Well, there are a number of measures which have been during the last years put in place by the government through legislation. Revis is for sure one of them. It's the Revenu d'Inclusion Sociale. This is a minimum income measure which covers those that are below a certain level. But there are also a number of tax allowances and tax credits that benefit particularly the working families, as well as unemployment benefits. Why did I put unemployment benefits there? Well, because the fact of being at work means only that you have worked more than half of a year of a given year, but the other 5 point something months you may have not worked. And then there are the so-called active labor market policies. Here there's a wide palette of measures. I've put just some of them, like reintegration of long-term unemployed, employment reintegration, training, retraining, and so on. And last but not least, the place of minimum wage. Well, minimum wage is supposed to be just one of the factors that have some influence on the level of inward poverty. It's not a panacea. So the fact that the government decides to increase minimum wage or to index minimum wage is not the solution to all problems, but still it is a very firm point and a departing point for the policies against inward poverty. Let me conclude with this. It's very difficult to measure inward poverty, so it's even more difficult to find out what is the place of the law and what could be the legal reforms that may help reducing inward poverty. We have seen that there's a combination between an individual dimension and a collective, a household dimension. What the law is trying to do is to favor, in particular, some situations, some conditions, to put in place the conditions for which individuals can be better off. There are still two very big missing points about the statistics on inward poverty. One is cross-border workers, and this is massive in Luxembourg, because these people is captured by the statistics of their own countries and not by our statistics. And secondly, the housing costs, which are outside from the basket of goods, because the measurement of inward poverty is not based on a basket, but is based on a relative measurement. But it's self-evident that not only income is important, but also and particularly the costs of living are important here. And this is particularly true for Luxembourg. And this gives me the opportunity to hand over to Francois and Christophe, who will then go on with particularly focusing on housing. Thanks very much, and I will see you later for the Q&A.
Very good. Thank you so much, Luca. Guten Mittag alle gut. Ja, ich bin froh, mit erstes Inhalt für die Resultate von meinen Recherchen zu präsentieren. Aber ich will auch echt ein großes vielmals Merci sagen an den Chantal, an den Sascha für die Organisation. Den UniTalks ist ganz wichtig für die Universität. To continue in English, I am very happy to be here to present you some overview of a number of projects that I've been working on. And so hopefully my remarks will very much be in the continuity of Luca's points, trying to focus a little bit more on the case of Luxembourg and the housing market. And in particular, I want to share with you the results, the key results from two recent projects that I've been working on. One is joint work with Ulf von Lilienfeld and Anastasia Gershina, where we've focused specifically on the issue of housing affordability and the relation to taxes, trying to answer in particular whether tax subsidies can help make housing more affordable. The second project that I want to give you a glimpse of is work that I've been doing with researchers in Statec and within the broader context of the COVID project with the support of the FNR, and work that has been trying to understand the implications of the COVID pandemic for the Luxembourg mortgage market. And so both projects are available online, so if you want to have a look at the paper, and in particular, here is the reference for the first paper with, as I mentioned, Anastasia from the Stockholm School of Economics and my colleague Ulf. So the motivation for the paper is the following picture, and this picture shows you the ratio of house prices to disposable income of households. For Luxembourg, France, Belgium, and Germany, it's quarterly data starting in 2010, and we normalize the series to 1 at the beginning of the sample, okay? And what do we see? We see that in Luxembourg and Germany in particular, house prices have increased, which we know, but on top of that, they've increased faster than income. So Luxembourg has known a strong GDP growth, while house prices have grown even faster, so that relative to income, house prices have become more and more expensive in Germany and in Luxembourg even more. I should say, if we zoom out a little bit for the OECD or for the US, we had a small decline after the subprime crisis, but if we look at the last 5 to 6 years, the price to income ratios are also going up, and so certainly this housing affordability issue is relevant at the global level, but certainly so for Luxembourg. And so to respond to these housing affordability challenges, one of the tools, one of the approaches taken by government is to provide subsidies to help make housing more affordable. And there are 3 types of subsidies generally. One is allowances. So that's shown here in red. So allowances would be the government that helps pay for your rent, for instance. Okay, you get a check from the government to pay your rent, and that would be here included in the allowances. Second type of measure are support to buyers, and so that would include, for instance, the government paying some part of your interest, where you get some subsidies on your interest payments. And the third type of measure are tax relief for buyers. So there are a lot of taxes on real estate, and so with these type of measures, the government reduces the taxes to make housing more affordable. And so what this picture shows you here is the resources allocated to each type of subsidy for the main countries in the OECD, and the resources are shown as a share of GDP. And what we see is that Luxembourg, similar in a way to the Netherlands, allocates very large resources to these housing subsidies, and in particular, a lot of these housing subsidies come in the form of tax breaks. And so the question we ask in this paper is, how useful are tax subsidies as an instrument to make housing more affordable? Okay, and if we want to understand whether tax subsidies are useful, so for example, if you buy a house, you could get a discount on the amount of transaction tax you have to pay. That's one big example of a tax subsidy in Luxembourg. So if we want to understand whether these taxes are useful, we need to understand their price impact. And I think the following example will hopefully make this clear. So suppose that the government says, I'm going to reduce the taxes that the buyers have to pay by 1%. Okay, so you're on paper, you're providing a subsidy to the buyers. But suppose that as a result of this, house prices go up by 1%. Then, in fact, what the government is doing is that it's not giving a subsidy to the buyers, it's in fact giving a direct transfer to the sellers. And so that's not solving the housing affordability issue, which there was in the first place. And so if we want to understand who benefits from these tax subsidies, it's very important to understand the price impact. And so what we do in the paper is we propose a theoretical framework, and we showed how the price impact of transaction taxes is going to depend on the 2 key features of the market, which are housing supply elasticity and housing demand elasticity. In the second part of the paper, we focus on the case of Luxembourg, where we measure the price impact. So while is Luxembourg an interesting case study, well, hopefully I don't need to convince you that Luxembourg is a very important case to study, but also from an international point of view, Luxembourg is interesting because there are specific features in the tax code that allow us to identify specifically the supply of the elasticity of demand and the elasticity of supply. And so without going in the details, you have thresholds in the law where the taxes that you have to pay go up if you go above some thresholds. And so using these discontinuities in the tax code, we can recover the fundamental characteristics of the housing market in Luxembourg. And that is a part we are currently working on, is understanding implications for housing affordability. And so what we find is that the elasticity of pre-tax prices is around 0.25. So that means that the sellers capture a quarter of the subsidy. So if you want this measure of the leakage going to the sellers, the households who already have a house, that's around a quarter of the subsidy. And our second point on the implications for housing affordability is that the implications are going to depend a lot on the distribution of real estate. So if you have some households that own really a lot of real estate, then the price impact can further exacerbate these inequalities in housing. And so these are the main conclusions from this paper, which again, as I mentioned, is available online. So feel free to have a look. The second work that I wanted to share with you is work that I've been doing with Pauline Perret and Huyen Tran, both at Statec, looking at the financial stability implications of the COVID pandemic for the housing market. And so the motivation for that project is, again, in two pictures. So this picture here shows you the ratio of debt relative to income, okay? And just like, as house prices have gone up in Luxembourg much higher than income, so households have had to spend more and more on housing. And so how do you do that? Well, you borrow more, okay? So households in Luxembourg have borrowed more and more and more, so that today, or these are the figures from 2018, Luxembourg is one of the countries in Europe with the highest debt to income ratios. And so this figure here shows you the different countries in Europe, and then the ratio of how much debt you have relative to income, okay? And we see that Luxembourg is second only to Denmark and Netherlands in terms of the amount of debt. And so this very large indebtedness of households is a big issue from a financial stability point of view. And for this, consider the very simple example. Suppose you you have 10,000 euro and you're going to buy or you have 20,000 euros, say, and you buy a house worth 100,000 euros. So your down payment is 20%, okay? If house prices fall by 10%, you lose 10,000 euros. You still have 10,000 euros left, okay? So you just lost half of what you invested. Now, suppose you have the same 20,000 euros, but you buy a house worth 200,000 euros. Well, in that case, if house prices go down by 10%, you are wiped out. And so there's big financial stability concerns that the higher households are indebted, the more sensitive their net worth, their wealth becomes to these changes in house prices, and in particular, if you have a fall in house prices, that can have very bad consequences for households. And so that's the motivation, like this initial fragility in the Luxembourg housing market. Then obviously comes COVID. And COVID was a very large shock for the economy. And it was also a very asymmetric shock. And so that's illustrated here on this picture, which shows you for the different sectors in the Luxembourg economy, the share of workers that requested partial unemployment during the COVID crisis, okay? So as the economy went into shutdown in March 2020, a lot of businesses had to put their employees on partial unemployment. And so that was a very important scheme brought by the government. And so this figure shows you the share of workers on partial unemployment. And we see there's a lot of variation across sectors. So if you look, unsurprisingly, sectors like Oresca, so that would be the hotels, restaurants, or construction, although that fell much more rapidly. These sectors, at the height of the lockdown, had more than 80% of their employees were on partial unemployment. If you look at other sectors, like, for instance, the financial sector, that's the other extreme, there basically there was no partial unemployment, and they were able to continue as before, and they were much less affected. So a very asymmetric, very strong shock, COVID, and also very asymmetric shock across sectors. And so we tried then in this project, together with Pauline and Huyen, we tried to understand the implications of this for Luxembourg. And so again, I send you to the paper for more details, but I just wanted to share with you this table. So I apologize, there's a lot of numbers, but I think it's a really fascinating table, and so I wanted to share it with you. So this table shows you the distribution of workers across the different industries in Luxembourg. And so you have here the different sectors: construction, industry, agriculture, public administration, etc. And then you have here domestic employment. And so domestic employment are the workers that work in Luxembourg, okay, that work in firms that are domiciled in Luxembourg, all right? And so here these numbers are in thousands, and so we have 471,000 people that work in Luxembourg. The third column here is national employment, okay? And so these are the workers that live in Luxembourg. Where do they work? And obviously most of the people that live in Luxembourg also work in Luxembourg. And so these are really the people that live and work in Luxembourg, all right? And here we see that the total amount of workers that live and work in Luxembourg is 268,000, okay? So we already see something that we know very well, right? Which is an important characteristics of the Luxembourg labor market, which is that a very large share of workers commute in and out of the country. We have around 200,000 workers that come in and out of the country every day to work in Luxembourg, that commute from abroad, okay? And so that's a very important distinction if we want to understand the implications for the housing market. Because the housing market in Luxembourg, well, we need to know where the people that live in Luxembourg work. And so let's have a look here on this, looking at where each workers work, and in particular where the people that live in Luxembourg work. And so that's shown here on this fourth column. You have the share of the workers that live in Luxembourg. And you see that the main sector of people that live in Luxembourg, where they work, is public administration, defense, education, human health. So that's basically the government. So they work for the public sector. Another important sector, which is very related, is extraterritorial institutions. And that accounts for 11% of the worker. Interestingly, these are workers that are not included in the domestic statistics because technically the European institutions, for instance, are not Luxembourg institutions, so they're not accounted there, but they are accounted there. And so we see that really most of the workers for European institutions actually live in Luxembourg. And so if we combine just European plus Luxembourg government, that's 42% of the people that live in Luxembourg and work in Luxembourg, right? What other sectors that are big? Well, the financial sector is also a sector where people tend to live more in Luxembourg. And in particular, we have only 39% of the workers in the financial sector that actually commute from abroad, all right? And then what are the other sectors where people commute from? Well, construction, industry, for example. In those two sectors, you have around 70% of the workers actually come from abroad. And so key message here is that we have an important segmentation where the people that live in Luxembourg also work in sectors that have been less affected by the COVID crisis. If you work for the government, then probably the COVID shock is a smaller risk for you, all right? And so this and other analysis in the paper led us to conclude that probably on aggregate, these features could help attenuate the shock of COVID for Luxembourg as a whole. However, when we do an analysis of the household level, so we obtained micro data on the household level exposure, clearly, and I think that's also a point that Luca mentioned, there are some pockets of the population that are much more at risk and much more fragile. And so that was the overall conclusion from our project. So with this, I hand over to Christos, and thank you very much for your attention.
Thanks so much. This is a truly exciting topic. And the title of this talk should be Trying to Understand Mortgages. In general, it's understanding mortgages is anywhere is one thing. Luxembourg is a very exotic country, but let me just stress a few things about it. So in this first picture, let's start from the European average of two things. The blue line is the progression of the rents, so the rental costs of housing, in the past 11 years in the Eurozone, in Europe, in the EU. And as you see here, this is a very, very smooth progressing line, nothing too special about it. So the rental cost increases to a great extent together with the economy. And the magenta line is house prices. So the first part reflects pretty much the sovereign crisis after the Lehman Brothers in periphery countries and this cooling down of the economy during those times. But since 2015, we can see that house prices have been steadily increasing throughout Europe. Let's go now to a picture that is related to what, forgive me for that, to what Francois has been telling us before. This red line is the summary of the picture you saw before. This is the price to rent ratio. It shows that the house prices have been going down and then up in Europe. But in Luxembourg, if you see, since more than 11 years now, the prices compared to the rental cost have been going up all the time. So Luxembourg is special. House prices compared to rents go up since before the crisis, before the Lehman Brothers. And here on the left panel, here's, as you see, house prices in Europe in general, as also Francois showed, haven't been increasing compared to GDP, compared to income, but in Luxembourg, they have been increasing since 2006. Okay, there are some fundamental reasons to have this. However, this picture here shows a lot. Luxembourg is the champion in increases in house prices. What is quite alarming here is that while rents in the past 11 years have been increasing by about 17%, house prices in Luxembourg have been more than doubled. And you could ignore transition economies here. They started with very low house prices for political other reasons. Luxembourg is really, really the champion. So Luxembourg stands out. What is quite interesting is that Luxembourg is also the champion in the growth spurt that we have seen during the pandemic. Actually, this picture is quite impressive throughout Europe, that during the pandemic, while GDP was going down, house prices were going up pretty much everywhere in Europe, but in Luxembourg, they increased by 13.3% just, during the pandemic. So why should we care about all this? Here's a picture from the United States data, since the US, since the 80s. And here's exactly the contrast between the gray line is the rents in the US. As you see, it's a very smooth line. This is the rental costs. And this is the house prices. House prices generally fluctuate, okay? But in the long run, the two lines, the black line and the gray line, shouldn't be departing that much from each other. The alarming number here is this 200, that before the Lehman Brothers crisis, before the subprime crisis, house prices had doubled, like in Luxembourg. They had practically doubled and they had departed very, very, very much from rental prices. Rental prices define what we call the fundamental price, where you should be. So that part is called a bubble. And the reason we should care is that we could have actually a housing bubble burst that truly hurts because it can take down your banking system. Real estate is inside the balance sheets of households, of firms, and of banks. So what happened with Lehman Brothers? It took down the financial system in the US, and you know the rest of it. So the reason we should care is many other examples. Japan went down in '97 exactly because of that. There was a real estate bubble going on since the 80s. In the 90s, it was totally out of control. And the name of the game, when you have such a thing, such a picture, which we seem to get there, we should be concerned in Luxembourg, is how can you go down, how can you correct these house prices smoothly and slowly? Now, let me touch upon the policy issue. This is the 10-year bond rate. So I have called this cheap money. What happened? Since 2015, there was the sovereign crisis around here. And since 2015, we have this quantitative easing policy of the central bank, which helps fixing the problems of balance sheets of banks in the Eurozone on the one hand, but on the other hand, there are side effects. When you are here down in the pandemic, these numbers, these negative numbers mean, for example, that somebody will give you, promises to give you 100 euros after 10 years, and then the market pays 105 now in order to receive, not inflation adjusted, 100 euros after 10 years. So cheap money is what pushes also the mortgage rates throughout Europe down. Luxembourg is on the low side also in Europe. And we have less than 2% mortgage rates. And here's a picture actually stolen from Static. It's a courtesy of Static about Luxembourg. What happens here is that you have the orange line and the gray line are the GDP, real and nominal, but then the blue line and the yellow line are the house prices and the mortgages. And if you observe, these two things go together. And why do they go together? Because when your house price increases and you still own it, you still pay it, you have a mortgage, and you set your house as your collateral, your credit worthiness increases. So you could buy a second house or you could change. Generally speaking, if you're about to buy a house that is expensive and you anticipate that house prices are going to go up, your credit worthiness increases. So the one feeds the other. So this is a typical example of a credit cycle that we have seen in Japan, in the US, and so on. And this is something actually quite tricky. Well, I have tried to put here the big picture. On the one hand, we have these too low interest rates. We have a central bank that during the crisis times has correctly been buying a lot of bonds in order to solve another problem, which was the banking problem. But then we have too low interest rates for a very long time. And then this, in a way, starts leading to very high mortgages because money becomes cheap. Then we have this feedback loop in the credit cycle, practically when house prices go up, then mortgages are more, then more mortgages increase the demand for houses that push, the house prices high. And actually this feedback loop works very, very bad when the bubble bursts, because then low house prices would be low credit worthiness. And as Francois explained, people can be wiped out, as he said. And then the fear of a bubble burst then again leads central bank, the governments, to practically support too low interest rates. Now, this can be a vicious circle, and the place to break this circle is somehow to do a tricky expectations management. Let me explain why this is tricky, because this is important to see the issues in economics. Let's go quickly to an example of a prediction. Let's suppose that we are predicting that next Monday, there's going to be a storm, okay? We have this prediction. So what should the government do? Evacuate houses, maybe, shut down airports. But no matter if you do it or not, the storm is going to come. On the contrary, if we predict that on Monday, next Monday, there's going to be this kind of stock market crash, what will the market do today? If the market believes it, they are going to trade today in such a panic that they will cause the stock market crash today. So the prediction will be wrong. So what is going on? What is going on in here? In the first case, the object is something independent from the subject, the predictor. Here, the object of prediction is the market, which is the decision maker. So the subject and the object interact with each other. This issue is the trickiest part in economics that one would like to resolve. How? By writing models that use the technology that you have in your GPS, pretty much. So when you drive your car and you miss the turn, your GPS says recalculating. It has a forward-looking plan, and it practically solves a very complicated problem. Using this kind of technology, we write models. And this is the example of a model we wrote at the university for the Luxembourgish market, but of course a general purpose model, where we look exactly with data that Francois showed you. We look at the balance sheets of different households, of people working in different employment sectors, and we look at the net worth in their balance sheets, and then we look at their trades. So if we basically consider a situation where the housing market has calmed, this is just an example, then houses get shocks, idiosyncratic shocks, as we like to send them above or below, and we try to predict in the model who buys, who sells, and of course the housing price is what we call endogenous, so it comes out of the model. So we try essentially to explain housing prices. Then we can hit the economy by a shock like COVID shock or anything like this. And what happens here is that you are standing at time zero and you are seeing the lockdowns, they are basically announced, or any governmental policies announced, and you foresee the evolution of the distributions, how people will trade, and you foresee the changes in prices. So this is how you try to do. You try to package this information. The evolution of these distributions is in the heads of the decision makers. So models do that. And generally speaking, the two important ingredients to have in a model is the forward-lookingness of people, that people plan ahead, and then that houses serve as mortgage collateral. The first one addresses this object-subject interaction problem I showed you with the weather, the contrast to the weather example. And the second is it creates this feedback that house prices feed mortgages and vice versa. So putting such elements in the model, I'm not going to explain this slide, but what I want to say is that these are results where you see, for example, how distributions evolve, who rents, who buys, who jumps out of this market of owners, who jumps in, and so on. We run experiments, for example, with central bank policies, with policies of tax allowances, and we try to predict what will happen, who will sell, buy, and what prices will come out. And generally speaking, two results. Even if you try to take some of the exotic data of Luxembourg as exogenous, you can still actually get that the prudential policy, correct prudential policy to cool down the market of 20% in Luxembourg would lead to a price slowdown. This is to be seen. And with monetary policy, just 250 basis points in mortgage rates can actually lead to a house price acceleration. So generally, the model is in the ballpark of the data. And what I want to say to conclude is that there is no quick fix for this problem. This departure of the black line, this is the house prices from their fundamental price, the rental cost, and the risk of this bubble burst. There's no quick fix for that. But generally speaking, where we stand, the solution is a gradual, long-term reintroduction of the housing market to healthy market forces. To give you a medical analogy, you have somebody who comes with a heart attack and underlying issues. You cannot put them on cold turkey diet or exercise. You have to actually put them in a healthy lifestyle, and this is practically what we need to do. For example, if somebody has an autoimmune problem and you give them cortisol for a very long time, there will be such strong side effects of cortisol that you will actually need to reintroduce them again in order to calm down to a healthy lifestyle. This is the regime we have been living. After the sovereign crisis, especially in Europe, we have been giving too much, like, let's say, cortisol to the economy, having these side effects that we see in Luxembourg and Germany in the housing market. And this is alarming, by the way, because there is this financial stability risk and we should be worried now. So to cut the long story short, in this vicious circle and this tricky expectations management, what we do with structural modeling, I explained to you how tricky it is to understand expectations, is that housing models are a tool for giving an advice in order to manage these expectations and slowly go down. This is actually the focus of my talk. It's time for Q&A. Thank you very much.
All right, so thank you very much, Professor Koulouvatianos. We're going to move on to Q&A. I have one quick question that came in for Francois on his slides. The question was, what period covers the income mentioned here? And that was on slide 10 of your presentation. So our listener just wanted to know the time period that was covered.
So it's on the debt to income ratios. Is that the...
Yes.
The slide, yeah, I think I can share it again. It's the data is taken from Eurostat, And it seems so on the figure shown here, it's data from 2018. But my understanding is that house prices have not abated since, and so these trends are certainly also valid now. But so to measure the debt to income, obviously the debt and the income are taken from the same period. Does that answer your question?
I hope it answers the question of the listener.
No, the question is if income is annual income or a specific period. It's annual income. It's annual income. Okay. So you take the income, the disposable income of households on a given year, and then you look at the debt, and then you compare the two. Bayram, does that answer your question? Great, thank you.
Thanks so much for clearing that up for me. Another question, probably to Luca this time. We know that lower working classes got even poorer, but what about the middle class in Luxembourg? How is the middle class doing? Are they also getting poorer with the higher prices of housing, renting and owning, childcare prices? Is the middle class now becoming vulnerable to poverty or relative poverty?
Well, first of all, it depends what you mean by middle class, but for sure there are some classes in the middle class that are more vulnerable than other ones. At least as far as statistics are concerned, because if we put the individual considering its household and we consider that an individual with more than 14 years working in living in a household counts at 0.5 and less than 14 years counts as 0.3, if I'm not mistaken. So it's quite, statistically speaking, it's quite complex, and I'm a poor lawyer, so I would never go into this jungle. But the numbers, but beyond the numbers, there's the reality of contracts of employment that are more and more precarious. And particularly, I think the biggest issue for the middle class is work intensity. Not all of middle class individuals have a full-time job, and not all of them have a permanent job. So particularly not the breadwinner, so to say, but the second earner in the family. The fact that he or she has an unstable job or a very low work intensity has a direct effect on inward poverty. So it may well be that also these people, these families are considered to be at risk of poverty.
Thank you. Thank you. We're going to go back to the economic side with a question for Christos. Somebody is more interested in learning about what the healthy, in quotes, market forces could actually be. They said that given that subsidizing the revenue-seeking strategies of property owners or developers with tax rebates, for example, are not going to solve any problems, and there's also distributional issues linked to that. They're asking, what about better regulation for the housing market?
Yeah, well, there are two aspects of it. Let's actually start from what is unhealthy. I'll be as brief as I can. Essentially, there has been a crisis before. In fact, there have been two kinds of crises. One was banking and the other was sovereign. And this is called the doom loop. That was more prominent in Ireland. So in Ireland, the problems of banks took down the government. In Greece, the government problems took down the banks, but they both ended up in the doom loop. So there have been a lot of lenders of last resort. One has been governments. The other has been ESM funds. The European Stability Mechanism is here. There have been a lot of remedies. And of course, there is the QE, which is by the independent institution. The central bank is constitutional. It's not governed by government. So what has been going on, it has been a lot of, it's not just regulation, it has been a lot of lending by lenders of last resort and a lot of promises about future lending from lenders of last resort. That is unhealthy. So the first thing to fix is to gradually remove that. Then when we speak about regulation, slowly you have to live we have to live in what you call healthy competition. Healthy competition means that you need to remove those who are inefficient and let in those who are more efficient, and that is more gradual. I mean, it's a general answer, but I'm as specific as I can about what is going on now and about the general answer. We can be very specific. You can contact me if you have questions about details.
I'm going to stay with you, Christos, for the next question, and another person that would like to have a discussion afterwards about more detailed information. But their question here is, how relevant is the Lehman scenario in the US to Luxembourg? They're saying that in the context of our predictions of a 2 times population increase, how much does the model need to almost perpetually readjust in the GPS metaphor? And he's asking, are we just pushing back the inevitable?
I think, there are 2 big differences. Back in the US, there have been their own credit ratings and the big 5. But here there are different risks and there are different overheated markets. I think we can avoid, if we sit down. Let me say one important thing. When the pandemic started, politicians felt the urgency, okay? And I must confess here that as member of the task force, I also said we should prescribe these very heavy medicines and remedies. Now, the short answer is that if we convince politicians to feel the urgency, not the markets, not to go out, and say, to feel the urgency to fix this problem gradually, we will fix the inevitable, in my opinion. The short answer is that the features now are different, but of course, bubbles adapt through regulations, through windows, through the laws, they adapt to new environments. But I think now we understand more and we can fix it. I'm quite optimistic about it, as long as we convince the politicians to feel the urgency.
And last thing right now, Christos, I had a couple of people ask, they want you to repeat what you think the long-term solution is. You said no quick fix, gradual, but what are the things that we can be doing gradually?
So a gradual long-term reintroduction of housing and credit markets to healthy market forces. Let me explain. To forces that select the more efficient and give the signal to the less efficient to do something else. Not in a painful way, but this is the healthy market forces. But gradual. We have to undo these very heavy promises of these insane interventions to credit markets.
Thank you very much, Christos.
If I can jump in and compliment, I definitely agree there. I think indeed one of the key issues there when we think about risk is the issue of debt. So if households buy houses just with their own funds, in a way, right? If they lose their job, if they have a sudden shock, well, at least it's a shock that they have, but there is no debt. They don't have someone knocking at the door at the end of the day. And so I think the key question is debt. That was the key issue also in the subprime crisis. There's a large literature in economics which has shown that this is really the key fragility that generates these financial crises. And so how to solve these is there are tools like macroprudential measures where you constrain the ability of banks to lend to households. And so you tell households you have to put a minimum down payment, for example. This is a very important policy tool. But obviously the other side of the coin is that if you put in place these tools with very high house prices, you're making it even more difficult for some households to access property. And so it's really a difficult trade-off that the policymaker has to face, where you don't want any debt, but you still want people to have access to housing. It's the trade-off, I think.
And I have a follow-up question on that for Francois. It has to deal with some particularities of the Luxembourg, bank lenders. It says, I believe many mortgages in Luxembourg operate with varied interest rates. If it's true, how does this impact the market as opposed to in other countries where a fixed rate is more common?
Yeah. So good Good question. I think the key issue there is about interest rate risk. And so if you take a variable rate mortgage, you have this risk that once interest rates go up, then the amount that you have to pay is also going to increase. And so ultimately there, I think one of the issues there is about the rate outlook and whether the central banks are going to increase rates, and there's been a lot of discussions lately with the rise in inflation, and so that could be an important risk indeed. If interest rates were to rise in the short run, that could be add further strain also to borrowing markets. Yeah, certainly.
Maybe another question that I'm just seeing. A couple of people have asked. You showed on the graph that the housing prices jumped rapidly during COVID. Are they expected to fall back just as rapidly, or are they expected to plateau or even rise more after the pandemic?
That is the well, I mean, Christos, look at it. It's the $1 million question. I guess so. If I knew, I would borrow a lot and then put everything right on my bets. Yeah, it's difficult. Though I think the models of Christos are very useful in understanding the different drivers and the perspectives. No, Christos, what's your view there?
Yeah, I mean, so I think the ideal would be to have. Let's speak about Luxembourg. Key thing, this is a picture that you didn't show, Francois, but I know you have it. We must increase the supply of houses. This is urgent in Luxembourg.
That is true.
If I could just go to tell the government something, it's do that and signal the market that there will be more space available. That's number one. Number two, it may not, I'm a home, I have a mortgage myself, but gradually one should take away the tax benefits, but gradually again, one can announce it. There are things to try. And the ideal answer is that house prices shouldn't fall. We shouldn't have people just selling their houses in panic. House prices might actually stabilize at some point and wait for GDP to come closer. And rental wait over time. It needs time to fix that, but that would be the ideal scenario. So my answer is that if we start having people selling houses in panic, this could trigger a bubble. We are in a fragile regime. But ideally, there are things to suggest, but we should start from the fundamentals. There are a lot of people and companies coming to Luxembourg and there's no space. Exactly, this is the picture of Francois. So the red line in this picture of Francois should start following a little bit the blue line. This is the quickest fix. This can be communicated very well. The signal must go to financial markets as well. There are other things. Luxembourg can kind of lobby in the European Union and the Parliament for the global problem that arises in Germany, Luxembourg, and the Netherlands. These are things that must happen slowly, and some of them behind closed doors. We cannot speak too much, and I don't want to panic anybody. I think the situation can be manageable, but I'm starting to be concerned.
Yeah, no, I think indeed, I fully second, and indeed there are the fundamental factors, and then you have the kind of financial accelerator or these bubble concerns. And it's true that here in Luxembourg, a very important driver of the movement is really the fundamentals, and so that's the one picture that I had put in the appendix initially, but it shows you here the net job creation. So one of the features of Luxembourg is that there's been a lot of new jobs created. The economy is doing well, and so if we look at the past decade, year on year, we've had generally 10,000 new jobs created. Then you go to the housing market and you look at how many new housing units do we have, and we have around 3,000 housing units. All right, and so there's really the mismatch, and so that explains also why there are so many commuters, etc., because there are not enough housing production, and so you have a lot of demand, very little supply. Well, that's the fundamental driver of this very strong increase. And then the key concern indeed, and that's fully agree with Christo's point on the financial fragilities. If you start putting in debt into this, there are really risks that when things go south, then everything collapses, and so that's a very serious issue. Yeah, thanks.
I think that today's webinar really leveraged on some of the synergies that we're creating between departments and our faculty, and this time it was finance and in law. So I'm really proud of that. I hope everybody, the over 100 participants that joined us, enjoyed the webinar, enjoyed hearing from our three researchers, and gained some insights into the very unique social and economic landscape that we have here in Luxembourg. So thank you very much, and bon appétit for those who still have to eat their lunch. Bye-bye, everyone.